Hello and welcome everyone to our August 4th, 2010 FXDD FX Street online training here. We're going to do a special presentation today. Very, very exciting stuff. Now our disclaimer is that we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so in our series here of anticipating the Forex trends, this will be part 7, using moving averages to anticipate, stay, and exit trends. Again, very glad that you could be here today. So we have Greg Michalowski. He is the FXDD Vice President and the Chief Currency and Trading Analyst at the company. Many of you know him from his speaking engagements around the world. He just did a fantastic and sold-out training in Los Angeles, California on Saturday. So hot off the heels of that, you'll have Greg today teaching and training. You can always get him on his Twitter account at twitter.com/GregMikeFX. I'm Sean Powell. I'll be co-hosting and helping along in the chat window if you have questions while Greg is presenting. Okay, so we have a contest going on now at FXDD. First off, this is our pole position bonus. Now, if you were watching the Formula One race on the weekend, our team won the race and also got the pole position, so we're offering an 8% funding bonus in the trading account. So you can get all the details at FXDD.com. Also, if you do like Formula One, we have a trading contest where you can win 2 spots to one of the next Formula One races, and this includes team paddock passes and VIP along with $5,000 in travel and accommodation. There's also 550 other cash prizes and Red Bull merchandise prizes you can win. Get all the details at FXDD.com on that. So, webinar housekeeping. The class today is going to be on Forex market analysis, trading strategies, and trading opportunities that Greg will teach you how to find for yourself. Please participate, make it great by asking questions. Keep them on the Forex topic, and then you can get more details on Greg, who is also a columnist for FX Street. It's blogs.fxstreet.com/fxtrader-link. So without further ado, I'm going to pass the mic and the ball over to Greg, and we're going to have a great class.
All right. Thank you very much. I'm going to put up my PowerPoint presentation. I assume everyone can hear me. I don't see, let's see, the camera's on. Let's see, microphone. Is the microphone on? Can everyone hear me? Mic on and camera on. We're both good. Great. All right. As Sean said, I'm going to be talking a little bit about moving averages and how you can use them to not only stay on the trends and but to anticipate the trends, which I think is most important if you're going to be able to catch a trend. It's so much easier if you can anticipate a trend, and also things talk a little bit about exiting trends at the end. I hope to get into some of the live markets, but the first part is going to be largely educational, but we're going to take a look at some examples that you can apply, that I apply in my trading and market analysis, and I find that the market tends to follow these most powerful moving averages as tools for trading trends. And before we get started, I'm going to take everybody back to their physics class, high school, and Newton's first law. I remember very little about physics, but what I do remember is that there was something called Newton's first law, and the law said this: an object at rest will remain at rest unless acted by an unbalanced force. And also the second part of that was an object in motion continues in motion unless acted upon by an unbalanced force. That's the law of inertia. Maybe some of you remember that from physics. I know it was a nightmare for me, probably for you, but as well. But now that is pretty simple. It says, something that's going to be sitting on the table ain't going to move until it moves, and something that moves isn't going to stop until something stops it. And they use friction and stuff like that in our physics class. But it also pertains, I thought about it, and as it relates to the market. And if I were to change Newton's law to make it Michalowski's first law, I could say something like a market at rest will remain at rest, that is non-trending, unless it is acted on by an unbalanced force. So something gets it going, something moves it outside of its non-trending range that we've been in. And those people looking at the euro dollar over the last few days and maybe the pound sterling as well have seen the market remain at rest in a fairly narrow trading range. In fact, we are into a simple about 57 or 8 pip trading range until it broke to the downside here this in just the last half hour or hour in the market. And conversely, a market in motion that is trending continues in motion unless acted on by an unbalanced force. That is, we find the balance of buyers and sellers coming together to start to make the market stop its trend. And what I, another way of phrasing that, and one that seems pretty obvious but hard to follow, is this: the market is either trending or it's non-trending. That is, it's either in motion or it's not in motion. The non-trending markets will eventually transition into trending markets, and trending markets will transition into non-trending markets. So, what does that say about anticipating a trend? Well, obviously, if the market is non-trending, i.e., today and yesterday, over the last 24 hours, where the euro dollar sat below the 40 level, 132.40 level, and found support, I guess, in the 80 level, that's a non-trending type range, and eventually it's going to transition into a trend. We don't know how long that trend is going to last, of course, but we'll talk a little bit about that as we get further on with our lesson here today. So, of course, I look at the moving averages, and I was listening to Rob Booker's presentation right before mine, and needless to say, it's a hard act to follow, but I hope to do myself justice, of course. But he looks at the 200 bar moving average, and so do I, and it's a simple moving average that I look at. But I also look at another bar, the 100 bar moving average, and that's my trigger. And people often ask me, why do I look at these two moving averages? And quite frankly, one of the main reasons is I go to CNBC and I listen to CNBC, which is 99.9% almost talking about fundamentals. Where's the next macro trend going to be? And they skip over the technicals largely. But when they do talk about technicals, it's invariably something like the 100 bar moving average or the 200 bar moving average. I heard it yesterday in reference to, I think, the S&P 500. So it's something that the market watches. And in my trading, what I found is that if the market watches if the market watches something, whether it be a trend line, a moving average, Fibonacci retracement, those are the three tools, by the way, that I use in my trading analysis. I want to be watching that too. And when I speak of the market, I speak of the majority of the traders out there, the smart people, the people who have thought trading through, who have thought about things like risk and defining risk, and the tools that most smart traders, most successful traders use are ones that are going to define risk and give you a either bullish or bearish bias, and that's what things like the moving average, a trend line, Fibonacci retracement does, because if the price is above the moving average, it says that the bias is bullish. And so if the price is greater than the 100 bar moving average, it says the bias is bullish. So traders will be focused on being long. If the price is below the 100 bar moving average, it says the bias is bearish. And once that 100 bar moving average is crossed, then you start to look toward targets down the road. I call it either on the bullish or bearish highway. So imagine if the market is moving down, breaks a 100 bar moving average. It could be an hourly bar. It could be, I look at the 5-minute chart, I look at the daily bar. If the market breaks that moving average on the 100 bar, the 200 bar moving average is going to be below that level. It's a lagging to the 100 bar moving average usually, and that will next become the target. And what I call that is my confirming moving average. It confirms a trend. If you're going to trade on or if a market is going to trend, it's going to go through the 100 bar moving average, and then it's going to go through the 200 bar moving average, and that will indicate that the market is indeed on the path to trending. And as long as the price can remain on that path, that is, stay. If we're imagine the market is trending to the downside, goes below the 100 bar, then the 200 bar. As long as the price can remain below those two moving averages, then the market is continuing in the direction to the downside. If the market should move above those two moving averages, or one of those two moving averages. The first one would be the 200, or generally the 200 initially, but then the 100 bar would lead the way. But if the market should move above those two moving averages, guess what it does to the bias of the market? It turns it back bullish. And it's hard to see in your mind's eye without seeing the picture, but this picture, pretty much shows it. I always use the blue bar as my 100 bar moving average, and the green one's my 200 confirming bar moving average. And you can see here at the bottom here, the market moves above. It is non-trending because the two moving averages are kind of coming together here. We'll talk a little bit about that in a little bit in a while here. But the market finds support against the 100 and 200 bar moving average here and starts its trend to the upside. That bearish. Oops, no chart here. No chart up. You see the chart? Everyone see the chart? Should see the chart. Chart good. Okay. You might have to log out in Mike, to see the chart. When the market moves back below the 100 bar moving average, notice how it tests the moving average here. It then starts its move to the downside. We have one little failed attempt to get back above the moving average. We go back to the confirming moving average, find our support here, and eventually start to move to the downside, use that moving average as its resistance level, and moves to the downside. When the market corrects back up, it goes to the 100 bar moving average, comes back down. This is a 5-minute chart in the euro, and this goes back to June as just an example from but I see this all the time. We come back to the 100 bar moving average, we break above that, move to the 200, and the trend moves to the upside. So it's as simple as that for the analysis of the moving averages. Here's another example. This looks, we can go from left to right here. It moves above the 100. And this is kind of a choppy type of market, but you move above the 100 and the 200, come back down to the 100, test it, move to the confirming moving average, move lower, come back up, test our moving averages, come back down, confirm, come back, test the 100. The market's non-trending here. Remember, trending markets transition into non-trending markets. That's what we're seeing here. Then the market finds some support along a floor here and starts to move back above the 100. Can't get above the 200. Has a little battle here, and then finally breaks above the 200, confirms a move, and you get the idea of the moves here and the use of these two moving averages. How you'd use them in their purest, probably rawest sense, if you will. And how you can follow the trends by using these two key moving averages that lead the way. Here's another example, of gold, and this was done again for my presentation this weekend. It shows that gold is approaching, and this is a daily chart, approaching the 100-day moving average. And on this day, on Friday, the market stopped just short of that 100-day moving average. Of course, today, what do we see? We're going to see, and let's look at that chart in a little bit, but we see the euro or the gold moving above the 100-day moving average. And when it breaks above the 100-day moving average, it tends to move away from that level. You can see we've held support against the 100-day moving average, move below it, came down 50% retracement, back up to the 100, consolidate, and then today we're moving higher in that currency pair. Now, I mentioned that it's always best if you can anticipate a trend. If you can anticipate a trend, the way that I've found, I found that the market gives a lot of clues as far as the anticipation of a trend, and it goes back to that saying, the Michalowski law, the Newton law, and all that, where I said that non-trending markets transition into trending markets. Now, most people think of moving averages as a trend it defines a trend. If the moving average is moving up, the trend is to the upside, price is above it, the trend is going that way. If the moving average moves to the downside, or starts with a slope to the negative side, the trend is to the downside of the trend is bearish, as long as the price remains below those two moving averages. The bias is to the downside. What most people don't realize is that when the market is non-trending, which is most important in anticipating a trend, if you know something is non-trending, eventually it will trend. But if you know that if the moving average is going sideways, that defines a non-trending market. So I'm always looking for those instances where my 100 bar moving average is going sideways, because that says, okay, over the last 100 bars, that's a lot of bars, isn't it? Last 100 bars, the next incremental bar that comes out, the moving average over that time period is still the same. It remains the same. And the longer that the 100 bar moving average goes sideways, like it is doing in this chart right here, this is the sterling versus US dollar on a 5-minute chart, the better I feel about the potential for a move to the upside or to the downside. So is that a way that you can anticipate a trend? It sure is. And guess what? Most traders make the most money in this type of move to the upside, where it happens really quickly. It's directional. It's higher lows and higher highs, and there's less fear in the trend. The question I see here from Kingsley, it's simple. I use simple moving averages in all my charts, the 100 and the 200 bar moving average. I go back to CNBC. Although traders tend to know the exponential moving average, they don't talk about it. And most of the traders around the world, in my opinion, will rather look at the simple moving average. I'm unbiased. I think an exponential moving average actually moves too quickly at times. I know it's supposed to represent the market now, or is supposed to weight the current market more. But I find that the simple moving average works the best for me. But if you find the exponential moving average works fine as well, you're always welcome to use that moving average. And by the way, traders could use other moving averages. The most important thing is that that it has what I find is that it has market action around that moving average. And what I mean by that is, look, it finds support against the moving average. It goes through it. It finds support. Then it uses it as resistance. It finds support. It breaks through and moves to a new low. It finds support, moves up to the top side. That's the most important thing that I like to see in the moving averages that I use, that the market reflects off of it. It moves away from it. It doesn't trade a lot of volume at it. It's kind of a point where, you put up a cross and say, get away. I want to get away from this moving average. So that's the most important thing. Do I use a 20 bar moving average? No, too quick on the Forex market. And I like to look at 5-minute. I look at hourly, look at the daily charts in my analysis. And the 100 and the 200 works well in all those time periods. And I'm looking for clues as far as, entry levels using all those, different moving averages. So why don't I continue, on, with the analysis, and then we'll take, the questions a little bit later. But certainly if there's, something that I see that's unsure in my presentation, I'll address it. Going back to this, 5-minute chart here, this is a pretty good time period here where the market is non-trending, and you can draw a line in here, have a floor here, you can have a ceiling here, and these red areas indicate instances where the market tried to trend to the upside but failed miserably. It tried to trend to the downside but failed miserably. And each of the time that the market did that, these two times, of the break, it actually, it's okay. These things happen. So if you're trading around the trigger, around the 100 bar moving average, and you buy the market and you see it go through, you're expecting for it to move higher here. That's what the market should do. When it doesn't go higher and it comes back within this period right here, either you're getting out in this area right here, or you're getting out when the market goes back below the 100 bar moving average. No blood, in your trading. You're trying to anticipate a trend type move. So you may actually buy here and sell here, and they actually go short here, and you're looking for the same type move, directional move to the downside. It doesn't happen. It moves back above this floor. Everything's defined in this period when the market's non-trending, moving averages moving sideways. You know your risk. Your risk is if the market moves above or below this 100 and 200 bar, or this 100 bar moving average. And finally, when the market fails at this level right here, we come up above the 100 bar moving average, and we have this key test right here. We come up to our ceiling here, our new ceiling here, and it breaks through that. I mean, it gives you the confirmation to the upside. Where would I trade on this move? I see this failure down here, and I would be interested in buying the market, especially after we go up to this high here and we come down and we hold this level right here? Does that give you a clue, folks, that there's good support here and the market may go higher? If you're looking at this chart and you're right at this level, what is your risk for buying at this point on this correction to the downside? Your risk is, from this level, maybe 151.78, 151.65. Now, you could give it down through this level, or even give it through the 100-bar moving average, maybe to 60 or something like that. That's your risk, but the fact that it comes down here and starts its move back up here, you could buy it anywhere in this area right here. Risk 10, 15, 20 pips on the trade. There's nothing wrong with risking 10, 15, 20 pips on a trade. You don't have to be a hero and risk 50 pips, 75, 100 pips. The name of the game is keep your risk to a minimum. Trade near levels that define your risk, and if you do that, and you're successful, and the market does what it should do, that is move higher and break out of this narrow trading range, which eventually it will, because non-trending transitions into trending. This is an extended period of time. The market is going to do what it should do and move higher. And some people think that, oh, well, you just got lucky, you just bought here, you could have, but we're trading at these borderline levels, and each of the time the market finds it, it moves up. Each time it goes through, it goes to the downside, breaks up, and eventually what we're looking for is this trend move to the upside. And because you are anticipating a trend, this is the most important thing, folks. Because you are anticipating a trend, why? Because the moving average is going sideways. It's going sideways for an extended period of time. Because you're anticipating a trend, you're able to stay on the trend longer. If you know it's going to rain, you're going to bring your umbrella, you're going to wear your raincoat. If you anticipate that it's going to trend, and the clues say that it's going to trend, you're not going to be scared when the market does this and corrects down here. Guess who's selling here? The people who got used to selling the highs here. They say, oh, well, the market moved higher. It's going to come back down and come back into our range. Let those people do that. They aren't anticipating a trend. You are anticipating a trend. Take this opportunity to buy against this old ceiling here, against this level right here, to even buy more against that level. Put your stop if the market goes below the 100-bar moving average at that point and benefit from that. That's what successful traders do, is they anticipate a trend from what the market price tells them, what their tools tell them, like the 100-bar moving average. The next clues or clue that I often get from the market that says that the market is non-trending, market non-trend, it transitions to trending, is what I call three's a crowd. Non-trending, two's company, three's a crowd. And this combines both the 100 and the 200-bar moving average in the analysis. And it goes like this. When the 100 and the 200-bar moving average converge with the price, it's three's a crowd. Remember that old saying, if you go on a date, you have two's company, but three's a crowd. So you don't want your buddy on the date with you when you go out with that woman of your dreams. You want your buddy to go away because three's a crowd. Well, it's the same thing in the Forex market. If you have two moving averages, this time 100 and the 200-bar moving average, and that converges with the price. Notice it's with the price. I don't look at crossovers of the 100 and 200. I only look at crossovers of the 100 and the 200 with the price. When those two moving averages converge with the price, it's three's a crowd. And in a lot of cases, almost, you can never say always, but the market is going to break away. It's going to go from non-trending to trending. And here's an example of the dollar versus yen. This is this week or last week or whatever. And you can see the 100-bar moving average here and the 200-bar moving average. Both are in an uptrend here. Both are moving at a pace to the upside. And then the market starts to consolidate as trending markets transition into non-trending markets. And what do non-transition markets eventually transition into? Trending markets. So what we see here is the dollar yen starting to converge. Two moving averages starting to converge to the same price. We have this, up and down motion here, a failure at the top, very similar to what we saw in the euro dollar. You are bullish here. You are bullish here. The market goes up. You are expecting the market to trend to the upside. When it doesn't, it gives you that clue, folks. And what else does it show you here? We come back down to our floor. We come back down to our moving averages, up to our moving averages here at the 100 and the 200. Are those two moving averages and the price converge? Yes. Is this threes a crowd? Yes. Look for a trend type move. Anticipate a trend type move the next time the market moves down through that level. Again, those people who, oh, well, I'm going to buy a dip here. The dip is, from 65 down to 50. They're going to buy a dip. It goes up, comes back down. Look what our moving averages are starting to do. They're starting to trend to the downside, come up to the 100-bar moving average. All those people who are thinking that the market's going to move higher. No, you're anticipating a trend. You stay in. You create your own luck. The market starts to move down. Look how it uses the 100-bar moving average. At this point right here, the market starts to non-trend. We move above the 100. You're probably out of the trade right here. We go to the confirming moving average here. It breaks above there. But what does it do up there, folks? It fails. It's okay for an indicator to fail. That often gives you even more confidence in the trend, that the trend is likely to reestablish itself. If I were to put a Fibonacci on this as well, I'm sure it would be less short of the 38.2% retracement of this move to the downside. It's another tool, but we're not going to talk about that here today. But this failure up here against our confirming moving average suggests, we're going to have some trouble here. Goes back below the 100-bar moving average, and you get another leg to the downside. Another failure above the 100. One bar moves above there, moves to the downside. Now we can't get above the confirming moves to the downside. The market, when it trends, follows these moving averages. Occasionally you'll get these, slip ups where the market moves above the moving average, but you're always looking for that failure as well. All these are trading opportunities right here, the failure right here, the failure right here, the move back down through here, the failure here gives a selling opportunity, the failure here. Why? Because you know your risk. You know your risk is in this area. The trend is down. You're anticipating a trend. You know your risk is if the market moves above the 200-bar moving average. Even when it fails, you can still benefit from the failure because it was so short. It was so quick. It said the market's not ready to go higher. This trend is still to the downside. Here's another example of gold. It happens in gold. It happens in all the currencies. It's just a way of life of what happens in the market. Two moving averages converge here in a non-trending. When you get gold in a non-trending market, you got to pay attention to that. The market starts to move down. It gives it one last move to the upside. Boom, 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 boom. Note how the 100 and the 200, how these things work. Trending leads to non-trending. You come up to the 200, you start to move up, and then it does its thing around those moving averages. The final thing that I want to point out from non-trending to trending is what I call trading between the goalposts. And what this again is something that you're not going to find in any sort of book until you read my book that comes out next year. But between the goalposts says this: when the price is between the 100 and 200 bar moving average. Note that it's in between the 100 and 200 bar moving average. The market is not sure of the direction. The price will tend to fluctuate between the moving averages before making a break higher or lower. And it's, again, the best way to demonstrate those words is to look at a graph. And here, what you see here is the 100-bar moving average and the 200-bar moving average. In this case, they're not anywhere near each other. They're far away from each other. This defines our goalpost. One goalpost is the 100-bar. The other goalpost is the 200-bar. You can see how the market moves up here, tests the 100, and then starts to come down below the 100-bar moving average. What is the bias here? What is the trigger? The downside. The market moves to the downside rather quickly, and actually it comes up, tests the 100-bar moving average here, and then moves. Probably some economic data that came out here, moved right up to the 100, and then starts to move back to the downside. We get through the 200-bar moving average, and what do we do here? We fail and move back between our goalposts. When this happens, you tend to see that the 200 now becomes our support, and oftentimes you'll see this action where the market goes back up to the 100-bar moving average, stops there, and comes back down, stops here, and then finally decides which way it wants to go, in which direction it wants to break. It could either go this way or it could go this way. But what I'm saying and what the market is saying when it does this is that, okay, we like the bearish, we like being below the 100-bar moving average, but we're not quite sure about this trend yet. Why? Why would the market say that? Well, it just trended to the upside. You can see how the moving averages are moving higher here. So obviously the market came from somewhere down lower here to get to this point right here. And the fact that these two moving averages are so far apart here, we haven't really gotten into a non-trending type market. Instead, we've gone from trending to trending, and by the way, you can do that too. Trending markets transition into non-trending markets, but trending markets up can transition to trending markets to the downside as well. That makes sense, right? And so the market is saying, we're not quite ready yet, but we could still see this market moving up here, or we could still see it going down here. So what you have to do as a trader is take clues from the market and follow them along. In this case, we fail up here, we move down below the 200, and the market starts to trend down. This is the non-trending where the two moving averages start to, or the 100-bar moving average starts to flatten out. Notice here, we have another goalpost situation where the market moves above the 100 and then moves back down. We're still in a non-trending range here. Moves above the 100 here and starts its move to the upside toward the 200. What happens here? It gives a big tail failure up there. It's not ready, just like it's not ready here. And what ultimately happens, here's what ultimately happened. The market came down toward this old support level, finds support against here, and then breaks out of the goalpost and starts its move back up to the upside. So this often also gives you clues to the upside for trend type moves. I can do another couple examples here, but I want to leave a little time left for some questions. Well, I got about 15 minutes, so this is just another example of how the market is in between the goalposts here, tries its move to the downside. You're bearish here. Actually, you're bearish at this point right here because this is a trigger, the 100. The trigger happens. We can't go to the 200. Come back up to the trigger. Can't get through. Still keeps its bearish bias. Moves to the 200. You're looking for a move to the downside. When the market breaks back above the 200-bar moving average here, that says it's not ready to go. We see the move back up to the 100, consolidation. Some economic number comes out here, causes this whole move to the upside and downside in 1 hour. And then it starts to move back to the downside, fails again, comes back up. What is this right here? We finally get to the point where the moving averages converge. We get threes a crowd, and the market then takes off to the upside. So not only do we have the goalpost situation here, but we had the threes a crowd, and the market started its move to the upside in a strong fashion here, using this as a support and the trend to the upside. And this just happened last week as well. So it was all in the clues that the market gives you. I will, let me see, I'm going to take the camera off here and get my charts up here just to look at some of the markets here and answer any questions that you all may have in regard to the presentation. Now, do you see my charts there? Yes. Give me a yes. Camera on. Can you see my chart in the euro? Someone give me a yes. Yes, good. All right. Now, Sean, do you have any questions here first, or should I take a look at some of maybe people can take a look at some of these charts?
Time frames or any time frames or the time frames you would typically use, either our 100 or 200 on. I do find that it works really well. I look at 3 different charts: the daily, the hourly, and the 5-minute chart, and I get clues from it in all the situations. Here's threes a crowd for the euro versus US dollar, 2 moving averages, moves to the upside, non-trend, starts to wander around the 100-bar moving average, 200, threes a crowd again, boom, to the upside. This type of action, it's non-trending here. It causes it's in a very narrow trading range. It's going to move above and below the 100 and 200 bar moving average. I still use those moving averages as clues to bias to the upside or bias to the downside here. And as long as the moving average is moving sideways, you have less fear or less chance of a big type loss. So I use the 100 as the trigger. The 200 should confirm. But, the thing is, if it doesn't, like if you get this move to the upside here, the market moves to the upside and fails above the 200, and you start to see this type of move right here at this range here for the euro is really going on for quite some time. Eventually the market gets real tired of this type of move, don't you? I mean, and
you're no different than the rest of the market. The market gets tired of this up, down, up, down, up, down, all that type of nonsense, I guess. And the market then decides, okay, which way do I want to go? If you trade around this moving average here, maybe the 100 and the 200 combined, and what we can see here too is these two moving averages are kind of going to the downside here. You can see lower highs coming in here off the euro. So there is a reason to be a little bit more bearish here. I will say that, I don't like the fact that it moved above the 200 bar moving average before moving to the downside. But the fact that we have lower highs is bearish. And when we start to get this move to the downside here and break through the low, we go down lower. We head down really in a pretty much free fall to the downside. Now, what I want to point out here is off the hourly chart here, and we can see off the 5-minute chart how that momentum developed and how we went below this floor here. We stayed below the ceiling here, and the moving averages were going sideways, so giving us somewhat of a clue. But what I'm concerned about here from a bearish perspective, obviously the 5-minute shows bearish, is that where did we stop here? Where did the market stop? And if I put my cursor on that point there, 131.31 is the 100-hour moving average. What was the low on the move to the downside? 131.30. So the market, rightfully so, because the market watches these moving averages. It found those buyers against the level right here, and that gives the fact that we held that level gives profit takers or buyers of the euro a reason to trade. If you can buy against this 100-hour moving average, what is your risk? Well, your risk is if the market really goes below this trend line here in the euro, and that level comes in at one. You can have your stop all the way down to about the 111, 14 or so level. So you're risking 31 to 14 on that trade, or you can just risk right now because the market is now up at 53. You can risk the move below the moving average level in anticipation that the market is going to find a bottom here and moving up. So it's kind of like half bearish, half bullish here on this move to the downside, only because that 100-hour moving average really held like a rock down there, and you see the market bounce up from that level. Do you have any other questions, Sean? I'll give you the mic.
Okay, thanks.
Okay.
Greg, so we've had a couple other questions coming in. One of the questions was, how long do you wait when you're going to get into a trade? I had alluded to the fact that we typically wait a couple bars. Maybe you want to go into further detail on
that. That's a good question, Sean, and listeners out there. Is how far do you want to wait? And a lot of times, folks, I will act right on the bar because I know from experience that when the market sits there and approaches a trend line or a moving average line, especially if it's in kind of a free fall, it gives me such great pleasure to sit there and try to buy against that bar as close as I can to that bar, and then consider, okay, where am I going to be wrong? And if I can buy as close as I possibly can to that borderline, I call these borderlines, bullish on one side, bearish on another, then I could willy-nilly just say, okay, well, I'm going to buy against the 100-hour moving average. I'm going to buy at 33, 34, 35. I'm going to put my stop at 16 or 12 or 11 or something like that. Maybe risk 20 pips, 15 pips on the trade because that I'll know I'll be wrong if the market goes that far. I might even go as far as saying that if the market trades 22 or 23, that we're going to be below this 100-hour moving average. And if it goes down to that 22, 23, and we are non-trending and we're looking for a trend type move, that if it goes below that level, then I don't want to be short when the market's at 25, when the moving average is at 32 at that point, anticipating a further trend type move. So I'll quickly get out of that trade, or I'll look for the break. If I'm not short from up here, then I'll look for the break of the 100-bar moving average move to the downside. So I try to get as close as I can to that. To the borderline situations, the 100 or 200 bar moving average, and often, more times than not, you will see that the market slows down at that level and moves off of either higher off of that level or lower. In this case, this is an interesting situation because this is kind of the same setup as this one right here, where the market moved below the 100-hour moving average, and if I go to that hourly bar there. And I bet you if I put up a 5-minute bar, you'd see that the market, sold off here. But what did we run into? We ran into that support line off of these two lows right here, and that caused the market to move back up. That's okay. A failure of the 100-bar moving average gave you more confidence to buy the market. And lo and behold, even if you bought against this 100-bar moving average and stopped yourself out, or stopped yourself out when the market went back below this level, you're kind of thinking, this held that trend line right there. You got to be prepared that the market is not going to make it through that level, make it to the 200-bar moving average, and you got to think that, the bias turns to the bullish side off of that failure. Exits. I see. Can you talk about exits? And I didn't really talk a lot about exits here today. What you want to look for. My feeling about exits is that we put too many traders put so much emphasis on looking for entries, and they fail to talk about or look at the exits. But the entries, at least in the systems or the way that I approach the market, and I just talked about moving average mainly here today, but I also use trend lines and I also use Fibonacci retracement levels. Exits should if you have a reason to do a trade, like the market broke through the 100-bar moving average or broke through the trend line or something like that, you should always have reasons to get out of a trade as well. And so the same tools that I use in my entry, I'm going to use in my exit. So if in this case, off the hourly chart here, obviously, I'm combining a few things here today, not just talking about the moving average, but if I have this trend line coming in here and I see that the trend line breaks here, I often always keep the trend line in here because I always find the underside of the trend line on the corrective moves back up to the upside. We obviously hit a floor here, came back, and what did we do? We came back to the underside of the trend line here. So this is a selling opportunity up here if you're just looking at the hourly chart. Why? What is your risk? The risk is if it goes 10 pips above and moves back within this channel. That's your risk, and that's what good traders do. Always trade against something. So if you're short in this area and you get lucky and the market moves below this floor and starts to come down and all, a good, an exit would be against the 100-bar moving average. Why? Because if you exit here, you can always get back in the trade if the market moves below that 100-bar moving average, then moves below the trend line. Then you know the market is going to go to the 38.2% retracement, going to go to the 200-bar confirming moving average. That's the chances. That's what you're looking for, is that again, it's traveling along the bearish highway. Sell up here against the trend line. What's your risk? The market goes above. What's your next target? The next target is this low right here. Sell through, moves through that level. Okay, what's your next target? The 100-bar moving average, 100-hour moving average. Okay, if it goes through there, what's your next target? Next target is a trend line. All right, if it goes through there, what's your next target? Hit 38.2% retracement, 200-hour moving average. And that's the way that you stay on a trend. Where you exit is if it doesn't go through the exit. If you can't get down that, if you're going down the highway and you can't get to the next exit, you can't get to this trend line, guess what? You've turned around and the bias may turn back to the upside. So you have to be a little bit more cautious on this move off of this 100-bar moving average. You have to say, we could start to move higher, and in which case you might take partial profit on the position, or even exit the whole trade, because again, If the market goes back below that 100-hour moving average, we're probably going to see the momentum through that level. So you kind of have to stay in rhythm with the market. I call it like dancing with a partner. You got to take what the market gives you, take the clues that it gives you, and act off of those clues. Exit. Do you also exit as moving averages cross? I only look at the crossing of the moving average when the price and the two moving averages converge. Here's a crossing of the 100 and the 200 right here. Where's the price? It's way up here. It's not near where the current price is. So the market just consolidates more here at this level. It actually allows the 100-bar moving average, the price to catch up with the 100-bar moving average, and then it starts its further move to the upside. What I'm looking for, Boyke, is for the two moving averages and the price to converge together. This moving average is at 72. This moving, that's a little bit too far as well. I mean, this is more of a goalpost situation here. But in this case, it actually doesn't work as well. Although you get action above and you get action below, and eventually the market moves higher. But what I'm looking for, trying to find a situation, better situation where the market really trends off of those two moving averages converging. And even though even though it looks like something like this, where the two prices and the moving average more or less converge here, the move takes this price around 100 pips to the downside here before it bottoms and starts to move to the upside. It's not necessarily a great example as well, but anyway, I'm more concerned about when the two moving averages and the price converge, and oftentimes that'll give you a better indication. So I think we're running out of the time here, so I've got to finish up here. Any last or once again, let me remind everybody that if you have any questions that I didn't get to, send me an email at greg@fxdd.com. That didn't go through. Hold on a second. greg@fxdd.com. I also maintain a blog at this website. forex.fxdd.com. That's where I maintain a blog in addition to the comments that I make on FX Street. And if you want to be on my email distribution list of Market Insight, just send me an email at greg@fxdd.com again, and I'll be happy to include you on that. Let me take this opportunity to thank the people at FX Street, Maud, Vicky, Adinda, for all that you do for the listeners, and I look forward to the next time that we speak, which is going to be in another couple of weeks. Thank you all.